PB tells us what the market is actually willing to pay for a company's equity. It shows how investors view the real value behind a stock. Not just the price you see on the screen, but what lies beneath it. When you understand PB, you understand the difference between price and value. Book value means assets minus liabilities. It's everything a company owns: buildings, machines, cash, patents, minus everything it owes. In other words, what's left on the balance sheet if everything was settled? Think of it like cleaning the table. If the company sold all its assets, paid every bill, and turned off the lights, the amount left over would be its book value. That's the foundation PB is built on. Priced book compares that book value to the company's market price. It's a way of measuring how the market values what the company is truly worth on paper versus what people are paying for it right now. The formula is simple: price per share divided by book value per share. It's one of the cleanest ratios in finance, a direct link between what's real and what's perceived. If PB equals 1, the market values the company exactly at its book value. That means investors believe the assets and its debt reflect a fair price for the stock. When PB is above 1, investors are paying more than the book value. That can happen when the market expects future growth, recognizes brand strength, or sees strong earning potential. Because sometimes what's written in the books doesn't tell the whole story. When PB is below 1, the market values the company under its book value. Investors pay less than what it's worth on paper, and that's not always a good thing. It might look cheap, but sometimes low means trouble. Falling profits, weak trust, or poor outlook. Always look deeper than the number. A low PB can mean opportunity or risk. The real question is, why? Find the reason before you decide. To understand PB, you must know price and value. Price is what you pay. Value is what you get. Some sectors, like tech and service, have high PB. Investors pay more for growth and innovation, things you can't see in a balance sheet. Others, like banks or industries, stay near 1. Their assets are tangible: buildings, machines, cash. More structure, less speculation. That's why you always compare within the same sector. Different businesses, different rules. A low PB can be a hidden gem or a warning sign. The number never tells the whole story. Maybe the market fears falling earnings. When confidence fades, prices drop fast, and suddenly value gets buried under emotion. But sometimes, hidden in that fear, lies a small, quiet opportunity. A company overlooked. A story the market stopped listening to. That's what PB helps reveal. How expensive the market thinks real value should be. It's not the full truth, but it's a sharp lens for seeing where perception and reality collide. Use it with PEPS and your own judgment, because numbers mean nothing without context. Together, they tell the full story, and that's where real understanding begins.